Dhiraj Agarwal is with us, co-head equities at Ambit Capital. Dhiraj, good to have you with us here. Thank you very much for your time. I think you have been, in your broader outlook, a little cautious. Markets have staged a spectacular recovery from the lows of March. We're almost practically at new highs. What's your sense? Where do we go from here?
So, in fact, we have relooked at our market outlook, and we have issued a big strategy report just yesterday, where we are now talking about the possibility of close to 21,000. And that's largely predicated on the fact that the bond yields are now 7%, and there is absolutely no reason, no indication of bond yields hardening. It could possibly drift even below 7. The tightening rate cycle is clearly behind. There could be some amount of softening going forward. So we have a proprietary EY-BY framework for forecasting the Nifty levels. The fair value for that works to a little below 21,000. So we are changing stance a bit on the bullish side as compared to being cautious, as I rightly said in the last commentaries.
Okay, we've got you then exactly at the right time. So you're saying you released a report yesterday, 21,000. By when, Dhiraj? And how much of the change in stance is just kind of the market, forcing you to do that? I mean, because you've got to stay current with what's happening out there.
No, it's actually not, because remember, this is not the first time markets crossed 18,000. So our stance has always been in the past that markets been range trading between 16 to 19. A few months ago, also marketed about 18,800, and we didn't change the stance at that point of time. And market did drift down from there to below 17,000. So market's been range trading for almost a year and a half, 2 years now. The primary reason for the stance change is actually the bond yields and the outlook on the bond yields. We were building it in 7.3, 7.5% kind of a bond yield outlook. We are softening it down to about 7% now. And that makes a little bit of a difference in terms of our target valuations for the market. But mind you, this won't be a smooth journey even now. This will be a choppy journey, because while the softening of the bond yield does result in a higher valuation or target valuation for market as a whole, the earnings outlook for next year looks a little bumpy at this point. And we think there could be earnings cuts going forward as compared to what the current estimates are. So it won't be a smooth linear ride, but yeah, we could head to about 21,000 in 40 years.
Okay, so just a two-part question then. Which are the leaders that could take the Nifty to that 21,000 level that you're guiding for? And in terms of earnings cuts, what exactly is the earnings cut that you're factoring in FY24? And which are the sectors that could lead it there?
So I think the consensus Nifty earnings for next year at this point is 980 or 985, that ballpark. I don't remember the exact number. We think what we are likely to achieve is more like 940. So we are looking at a 6-7% kind of an earnings cut going forward next year. The sectors which are a little vulnerable to earnings cuts, we are seeing some headwinds in IT, largely because of what's happening in the Western world. We are seeing some amount of headwinds in metals and all commodities space, because China growth is not rebounding as sharply as what is required at this point of time for buoyancy in metals. Even in banking, which will account for roughly half, about 44% of the earnings growth in FY24, at some point of time, we will start seeing margin pressure, because the deposit costs are going up and lending rates are not keeping pace. And especially in a flattening to softening headline interest rate environment, it'll be that much more difficult to pass on the lending or rise in the deposit costs in terms of building higher lending rates. So there could be a little bit of disappointment from many sectors going forward, and hence the current market hope or expectation of 980, 990 is unlikely to be met. But at the same time, the interest rate environment is turning benign, which can, in a sort of a bumpy way, take the markets up to our target levels.
All right. Hi, Dhiraj. Good morning. Dhiraj, what about rural India? That was a bit of a pain point a few months ago. I think, you've been keeping a close eye on that as well. And there were signs that maybe it's bottoming out. What's the latest on that, and how would you play that theme?
We think it's bottoming out, yes. There is possibly a small sign of rural growth wage pickup also in the recent few months. Not a full-blown turnaround yet, but yeah, there is a ray of hope within the rural India. So, I mean, the rural plays obviously the obvious ones. It's FMCG, it's a little bit of autos. Those are the ones which we see might see a little bit of a volume or demand rebound if the rural India revives. And mind you, there's another large force at play at this point of time. Just a few months ago, WPI was ahead of CPI by almost 10 percentage points. So WPI was running at 16, 17, CPI at about 6, 7, or more in the 6 range. And now WPI is below CPI by 450 basis points. So that's a huge swing, almost unprecedented swing of like 1,500 basis points in the reverse direction. And when WPI was running ahead of CPI, companies after companies, especially the companies facing the consumer, so B2C companies, as we classically say, were facing margin pressures. We saw GRM cuts of 400 basis points to 1,200 basis points, depending on which company you're talking. And a lot of that can now get reversed with WPI now meaningfully below CPI, and it can sustain there for a few months or a few quarters. So that would be an additional bump in terms of earnings trajectory of B2C companies.
Okay. Just want to point out that many spaces are doing quite well, actually. So don't lose sight of that. The entire tire space is abuzz. Of course, JK Tires is seeing a little bit of profit taking perhaps, but something like an Apollo Tires is up another 1%. Honeywell is up about 7%. Devyani International is up 5%, despite some weakness in numbers yesterday. Chola Investment has hit a fresh high. Kajaria Ceramics is back on the buyers list. KPIT Tech is back. So a lot of these favorites, whether it's, home improvement theme, mid-cap IT space, consumption has come back. From some of these non-index movers, Dhiraj, where would your preferences lie? Whether it's home improvement, whether it's auto ancillaries, consumption, any specific areas that you think there could be more earnings potential?
I think it's more stock specific or company specific rather than sector specific. So one area where across the board we'll see some amount of margin positive impact is, as I said, B2C. So as compared, differentiating it from B2B or differentiating from wholesale kind of businesses. Simply because the input cost ran up very sharply for 4 or 5 quarters, and the companies were not able to raise prices at the same pace. So that entire space could see some amount of margin improvement. So a few examples that you mentioned right now, like tires. Tires had 500, 600 basis points gross margin jump just last quarter itself. And that's what I was talking about when I said WPI CPI gap has swung by a massive 1,500 basis points in just a span of three months. And when a swing of that size happens, it's sometimes difficult to estimate or forecast what exactly the GRM swing could be. And we would see more surprises going forward if this trend sustains, which we think.
Okay, all right, Dhiraj, always good hearing your thoughts. Thanks so much for stopping by. Wishing you a good trading session ahead, and we look forward to catching up with you soon.